Welcome to Safe Simple Sound Podcast, Tax Edition. This episode is a guide for navigating the complex intersection of grief and the IRS, specifically focusing on filing tax after the death of a spouse. Our goal is to make sure your strategy remains safe, simple, and sound even in the most difficult times. Let's get started. Now, if you're scratching your head thinking, I have never heard of qualifying surviving spouse, you might know it by its old name, qualifying widow. The IRS changed the terminology, but the intention remains the same. I like to think of this status as a financial bridge. Imagine you are driving down a highway called the married filing jointly. It's a wide road with generous speed limits, or in tax terms, generous deductions and lower rates. When a spouse passes away, the fear is that the road suddenly narrows into a single filer lane where the traffic is tighter and the tolls, your taxes, go up. The qualifying surviving spouse status is the bridge that keeps the road wide for 2 additional years after the year your spouse passes. It prevents your financial life from contracting at the exact moment your personal life feels like it's turned upside down. Let's look at why this is such a sound strategy, specifically focusing on what I call the educational generosity of the tax code. First, the standard deduction. For the 2025 tax year, the standard deduction for widows qualifying for QSS is $31,500. To put that in perspective, this is exactly double the deduction for a single filer. You are a single parent suddenly managing a mortgage and tuition on one income. That is an extra $15,750 of income that the IRS essentially says, keep it. You need this more than we do. But it's not just about the deduction, it's about the tax brackets. When you file as QSS, you are utilizing the same favorable tax brackets as married filing jointly. If you were forced to file as single or head of household, your income would climb into higher tax percentage brackets much faster. By maintaining this surviving spouse tax status, you keep more of your hard-earned income in lower percentage buckets. It's a buffer against the financial instability while you are grieving and adjusting. And for my listeners in the golden years, this is crucial. If you are age 65 or older, the benefits go even further. Thanks to the One Big Beautiful Bill Act, there is an enhanced deduction for seniors. If you are eligible, this can add up to $6,000 to your total deduction. Think about that for a second. If you are managing an estate, dealing with medical bills, or just trying to preserve assets for your grandchildren, that extra deduction is a shield protecting your nest egg. I want you to reflect on your own situation or perhaps that of a parent. Filing taxes after the death of a spouse is often done in a fog of grief. It is easy to just check single because it feels like the honest answer. But if you have a dependent child at home, single might be the wrong answer and an expensive one. Are you effectively using this 2-year window to stabilize your finances? Are you taking advantage of the time this bridge provides before you have to cross over to a different filing status? Here is your safe, simple sound call to action for this segment. I want you to dig out your previous tax returns, review them to identify your marginal tax bracket, then simply compare the math. Look at the difference between the standard deduction for single status versus the qualifying surviving spouse status. Seeing those numbers on paper is the best way to understand the protection this status offers. But here is the catch. Not everyone gets to use this bridge. The IRS has very specific checklist you have to pass, including a strict rule about dependent children. So how do you know if you actually make the cut? That is exactly what we are going to tackle next, the eligibility tests. The IRS has a bit of velvet rope around this filing status. It's not automatic, and unfortunately, simply being a widow or widower doesn't grant you entry. You have to pass what we call the eligibility tests. So if you're navigating filing taxes after the death of a spouse, specifically looking at the widow tax benefits of 2025, you need to grab a pen. There are 5 specific hurdles you need to clear to claim this status. First up, let's look at the foundation, prior eligibility. Ask yourself this: in the year your spouse passed away, were you eligible to file a joint return with them? Even if you didn't actually file jointly, could you have? Basically, if you were divorced or legally separated before the date of death, this door is closed. You must be part of a recognized marriage at the time of passing. Second, we have the marital status rule. To check the box for surviving spouse tax status for the 2025 tax year, you must remain unmarried through the end of the year. If you found love again and remarried before December 31st, that's wonderful for your heart, but for tax purposes, you would file with your new spouse, not as a qualifying surviving spouse. Now let's get to the biggest hurdle, the one that causes the most confusion, the child requirement. I cannot stress this enough. This status is designed for single parents or guardians. To qualify, you must have a son, daughter, stepchild, or adopted child who lived in your home all year long. Now, real life happens. If your child was away at college or on a military deployment, those are considered temporary absences, and that's fine. But here is a critical distinction that trips people up. Foster children do not qualify you for this status. If your household consists of you and a foster child, you cannot file a qualifying surviving spouse. You would likely look at head of household instead. And finally, there is the financial support test. The IRS wants to know who is keeping the lights on. To qualify, you must have paid more than half the cost of maintaining your home for the year. We are talking mortgage, property taxes, food, utilities. If you are living rent-free in a relative's home, or if another family member is covering the bulk of the bills, you might not meet this specific test. Reflect on your situation for a moment. Do you meet that specific definition of maintaining a home? And think about who is sitting at your dinner table. Is it an independent adult child who pays their own way? Or is it a dependent child, perhaps a minor, or even a disabled adult child who relies on you? That distinction changes everything. So here is your call to action for this segment. Before you open up your tax software or call your accountant, I want you to create a simple household checklist. Write down every member of your home. Confirm their relationship to you. Remember, biological, step, or adopted only. And verify their dependency status. Make sure you clear that child requirement hurdle first. It is the key to unlocking rest of these benefits. Once you have confirmed you are on the list, the next question is timing. How long does this status last? So let's transition to the timeline because the IRS runs on a very specific clock. We call this segment the 2-year clock. And honestly, this is where the strategy really comes into play. When you are filing taxes after the death of a spouse, the IRS actually views your transition in 3 distinct stages. I like to think of this as not a cliff you fall off, but rather a ramp that the tax code has built for you. Stage 1 is the year of death. Let's say your spouse passed away in 2024. For that specific tax return, provided you haven't remarried, the IRS treats you as if you are still married. You file married filing jointly. You get the full standard deduction and you use the joint tax brackets. It's status quo in a year that is anything but normal. But then the clock starts ticking. Stage 2 covers years 2 and 3. This is the qualifying surviving spouse window, or what many of you still know as qualifying widow. This is that educational generosity we mentioned earlier. For the next 2 tax years, even though your partner is gone, the IRS freezes your tax bracket and your standard deduction is at the married level. Think about that for a second. For the 2025 tax year, that standard deduction of $31,500, if you are forced to file as single immediately, the deduction would be cut exactly in half. That is a massive difference in taxable income. I want to pause here and ask you, where do you currently fall on the timeline between the year of death and the expiration of QSS window? Are you in the middle of year 2 or are you approaching the end of year 3? This matters because stage 3, year 4 and beyond, once the 2-year clock runs out, the bridge ends. You will typically transition to head of household status, assuming you still have a qualifying child at home, or eventually to single. Here is the reality check. While the head of household offers better rates than filing single, it is not as generous as QSS status. Your standard deduction will drop and your tax brackets will tighten. So here is the strategy. We need to use this 2-year window to stabilize the ship. So here is the S3 takeaway. First, it's safe. This status provides a secure foundation during the most vulnerable years of widowhood. It ensures your tax bill doesn't spike while you're figuring out how to live on a single income or paying off funeral costs. Second, it's simple. It's about consistency. You have been filing married for years. This status lets you keep doing that math for a little while longer. And finally, it is sound. This is the long-term play. How can you utilize the tax savings from QSS years to prepare for potential tax increase in year 4? Maybe you can use the tax refund generated by the higher deduction to pay down high interest credit card or to top off an emergency fund. You are essentially using the widow tax benefits of 2025 to build a buffer for 2027 because eventually you will have to file differently, but you shouldn't have to worry about that while you're in the thick of grief. The 2-year clock buys you the time to breathe, plan, and adjust. So here is your call to action for this segment, and it is a practical one. I want you to take out your phone or your planner. Mark your calendar with the specific tax years you are eligible for QSS and then circle the year you will need to transition to a new filing status. See the date coming, plan for the shift, don't let year 4 catch you by surprise. Coming up next, we are going to get into the weeds of the paperwork. We are talking about filing logistics, which box to check and where to write your child's name and how to avoid processing delays on your Form 1040. I know nobody wakes up excited to talk about IRS Form 1040, but stick with me. because this is where we lock in those benefits we just talked about. If the qualifying surviving spouse status is the vehicle that protects your assets, filling out this form correctly is the key to starting the engine. So let's look at the logistics. When you sit down to file your 2025 return, whether you are doing it at your kitchen table or sitting across from a CPA, there are three critical steps to remember. First, you have to claim the territory. On the top of Form 1040, you are going to see a list of filing statuses. You need to verify that you check the box labeled qualifying surviving spouse. Now here is a pro tip, especially if you have been doing this for a long time. You might be looking for the term qualifying widow. That was the old name. The IRS has updated the language, but the benefit remains the same. Once that box is checked, when you actually go to calculate the tax you owe, you are legally entitled to use the married filing jointly column in the tax tables. That is the magic movement where you stay in the lower bracket, keeping more money in your pocket for your family. Second, and this is a detail that trips people up, let's talk about the child requirement. We established that you need a dependent living with you to qualify. Usually, you list them as a dependent on the form. But there are rare cases where a child qualifies you for QSS status, but you are not claiming them as a dependent that specific year. Maybe they had some income on their own, or there is a shared custody agreement. If that's you, listen closely. You must manually enter the child's name in the specific entry space right next to the filing statuses checkbox. If you check the box but don't provide the name, the IRS computer essentially says does not compute, and your return will get pulled for review. We want to avoid those processing delays at all costs. Now I want to pause and ask you, do you have the necessary documentation and support to file your return correctly? Does looking at these forms make your heart race a bit faster? If the answer is yes, you are not alone and you don't have to do this solo. If you are feeling overwhelmed, particularly if you are in the 60 plus demographic we talked about earlier, please take advantage of the tax counseling for the elderly or TCE program. This is a phenomenal resource. These are IRS certified volunteers who specialize in retirement related tax issues. They understand filing taxes after death of a spouse. They understand pension, survivor benefits, and the specific anxiety that comes with managing finances alone for the first time. It is safe and it is compliant and it is there for you. And that leads us to the final thought for the day. The sound strategy. Using the QSS status isn't just about getting bigger refund in April. It's a long-term play. By utilizing the $31,500 standard deduction, you are preserving your liquid assets. You are keeping the estate intact. You are building a bridge that allows you to adjust to a single income household without the shock of a sudden tax hike. So reflect on that for a moment. Are you taking advantage of available resources like the TCE program to ensure compliance and peace of mind? To wrap up, check the qualifying surviving spouse box. Don't forget to list your qualifying child even if they are not dependent, and use the married tax tables. If you want to ensure your 2025 filing strategy is airtight, I want you to take action today. Visit irs.gov/TCE to find a counseling location near you, or pick up the phone and schedule an appointment with a tax professional. You have the right to quality service and clear explanation. And that brings us to the close of this essential episode on the qualifying surviving spouse status. I know that navigating the administrative side of laws is heavy, but understanding these rules is a vital step in keeping your financial house and your family's future secure. Today, we walked through the specific widow tax benefits for 2025, focusing on how the $31,500 standard deduction acts as a financial bridge during the toughest years. We clarified the confusion between legacy term, qualifying widow, and the current IRS definitions. And we tackled the strict eligibility tests to ensure you are not caught off guard by the child requirement. The most critical takeaway here is the timeline. Remember, this surviving spouse tax status is temporary. By leveraging the 2-year clock, you can stabilize your finances now so you're not overwhelmed when you eventually transition to head of household or single filing. It's all about filing taxes after death of spouse with a strategy that prioritizes asset preservation and peace of mind. Thank you for trusting me with your time today. If you are currently managing this transition or know someone who is, I highly recommend visiting our show notes. I have included a link to the tax counseling for the elderly locator and a printable checklist to help you determine if you meet the specific QSS criteria. Please subscribe to the podcast so you don't miss our next conversation. Until then, take a breath, review your options, and remember, keep your strategy safe, keep it simple, and keep it sound.